Hey, what's up, everybody? It's your boy Juju, and welcome back to the 1% of Juju podcast, where we teach you the practical steps to live your life like the 1%. Welcome back. Like I said, make sure you do subscribe to the podcast. Do that right now while we're waiting and while I introduce my lovely guest I have here today, one of my dear friends. She is a financial advisor, and she is absolutely amazing as a person, first of all. So I'm so excited to have her on the podcast today. Allison, introduce yourself to everybody. Welcome to the podcast.
Oh, that was so nice. I'm glad to be here. If no one has sung your praises, everyone, he's amazing. But yeah, I'm glad to be here. And I know this has a financial emphasis, and I started my career back in 2017. But I always tell my friends it's kind of my secret life, because it's really the only time you're going to catch me in a suit and heels. My friends see me more as the tomboy who's always in sweatpants no matter the occasion.
That is very true. So most of you guys don't know, but I used to work with Allison, and it was always a challenge to get Allison to actually come to work dressed professionally. Like, she used to be literally in our office in Nike flip-flops, which I used to love, and it's absolutely amazing. So that's who she is, and that's great.
Absolutely. And I don't think it inhibited me. I think it empowered me, but I don't know. I do tend to strategically rotate through the 6 shirts I do own, though. It takes but the simple life, right? So
that's what it's all about. I think that for every young person that kind of like steps into the corporate world, like that's what it's for, trying to figure out, like how to match up the tie, where for guys out there, how to match up the tie with the shirt to make it look like it's a different combination, but actually you're rotating for the same 3 all the time. But no, good stuff. Well, guys, obviously you guys know that we're in a 5-episode series. This is episode 4 of a 5-episode series on how to start investing. And today we're going to talk a little bit about kind of like mutual funds and ETFs, things of that nature, like stocks, bonds, what those things are, right? You hear those fancy words, just kind of describing them overall. And we have an expert in the field. Like I said, she is a financial advisor, so she's going to give us a couple. We're going to go into what is allowed from a regulation standpoint. There's some things that can be disclosed and some things that obviously cannot. But we want to speak about giving you some advice if you're to start not your investing journey per se, or like advice as far as like what to go invest in, but we want to give you advice as far as like how to start saving or what to even think about if you're starting that investing journey. But let me ask you this question to start. You work with a lot of people. If you were to take the average American, or, we have a lot of people in Canada listening, so the average person, would you say that they're good savers in general, or the things that they learn or the things that they take through life, would you say that those are efficient or good habits per se?
Yeah, it's a good question. And unfortunately, no, it's one of the most personal, but least educated topics.
Yeah.
Americans, under the age of 35, an average savings account balance is a little over $11,000, and that's what they have to their name. And these aren't really the people I'm speaking with day to day, but it just goes to show the lack of financial literacy throughout the country. I mean, saving is hard. It's hard work, and knowing where to save is also hard.
100%. I think that's almost like the daunting part, when you want to get started in the game, where you're looking at it all and you're like, okay, well, I don't even know where to start saving. Now you're telling me, I need to save a certain amount. I need to know the right place. I need to know all these right vehicles. And really our goal here is to simplify that as much as possible. And one topic that I think that is always like so confusing to people, and I remember having to explain that to clients, is like there's all these huge terms that are thrown around, and it's like mutual funds, ETFs, stocks, bonds, and all those terms, and people don't realize that. They're like, oh, well, I invest in stocks, but they don't realize that, or I don't buy stocks, but they buy mutual funds, but they don't realize that it all comes together and it's all the same. But so let's try to define that for the people. But if you were to speak about like what a stock really is, how would you define that in your lingo, or how would you define that to your clients?
Yeah, we can run through, a few basic definitions too. I think it also might be helpful because honestly, I do feel like sometimes the most value I can bring to clients is arming them with the right information and inspire them to save more in the
Yeah,
right places. And
100%.
so we could talk about, different places and, just trying to utilize that. But I think it's helpful too, just as an overview, to try to step in, a little bit to the shoes of your average investor, young professional. And generally speaking, at least most of the people I'm talking to, they usually actually have maybe a little too much in their bank account. It's being eaten away by inflation. They've got something in their 401k, maybe a Roth IRA if they're
Yeah.
under the income limit, and they're wondering what investments they should be utilizing, right? They just kind of picked one option and asked someone for advice that satisfied a really quick decision. And,
Yeah.
then they are most likely utilizing Roth. They're not really sure. Usually they have a random Acorns account that their brother-in-law who does something in finance told them to set up. But they always want to know where else they should be saving. And they always want to have a plan and know that it's working to actually accomplish their goals. Because there's something, I always find that people have so much random advice that oftentimes there's no threaded through theme that actually brings the plan together in a cohesive way, right? There's
100%.
so much, and we were just talking about this on the phone.
Yeah.
But there's just so much information out there, and in the age of technology where everyone thinks they can be an expert in everything, I mean, yikes, I've seen some poorly constructed plans. So yeah, hopefully today I can give some information without giving any kind of blanket advice,
Yeah.
that will at least start the conversation in a few households. And yeah, we can start with a stock, which, yeah, I'm sure, I mean, people have heard, right? A stock.
Well, you'd actually be surprised because you spoke about at the beginning, right? Like the basic finance. And I really liked everything you said, because everything here, it's really about the mindset. But a lot of people, like some of those basic concepts, like what is a stock, like what is it, in fact, like people wouldn't necessarily know that, and they feel almost ashamed to ask the question, right? Like what is a stock, like what is involved when I buy one stock, like what does, am I now liable if the stock goes to zero, or what is it, like if you were to explain it in simple terms to one of your clients, I guess.
Yep, absolutely. And you're right, it doesn't matter what age you are. I can attest from meetings just this week.
Yeah.
It doesn't matter how old you are. A lot of people don't know. So a stock, or an equity, it's a security that represents you own a fraction of a corporation, right? Like a stock in Apple. So you can have multiple stocks or shares in a company, which entitles you to a portion of that company's profits. These are predominantly bought on the stock exchange, right? You can purchase them online from a stockbroker. You've probably heard of platforms like E-Trade, or, so companies sell their own stock to raise funds to operate their business. So you could go on E-Trade and stock if you really trust yourself and, are doing a lot of research and are comfortable with that risk. But there's a lot of different kinds of stock. A lot can depend on, per se, so a company's size, right? If you're familiar with large cap or mid cap or small cap, that divvies up different asset classes you can invest in. So that has to do just with how large or small a company is. If the market value of a company is over 10 billion or more, well, that's going to be large cap.
Yeah.
Facebook, Tesla, Amazon, right? So, and then even from there, I mean, you can divvy into different industries, different sectors like energy or technology and so forth. And then you can look at location, inside or outside of the US, emerging markets, right? So people are generally looking for areas that are poised for expansion. There's a lot of ways to do that. There's also different styles too. I'm sure you've heard of like growth and value stocks.
Yep. Can you speak to the difference between those two? Because I think that those are the terms that people might get a little afraid of when they. Yeah.
Oh, of course. And generally speaking, growth stocks are quickly growing companies
Yeah.
that investors are eager to pay a little bit more for, whereas value stocks are essentially deemed to be like undervalued or underpriced, right? So the assumption is that they're trading below what they're really worth and will, inevitably provide a superior return.
Yeah.
I'm not going to give my thoughts here, but that's hopefully a helpful overview. But one thing, and I can even pull this up and show you too, but the last thing I think maybe just to round up as far as the discussion on stocks, let's see if I have it. Oh yeah. So diversification, right? Everybody's got that one uncle that says, just invest in the S&P 500.
Yeah.
So let's just look at this because you might want to rethink that. I don't know if your viewers will be able to see my screen and share it, but whatever. So here's this piece.
So, but otherwise I'll share the screen. I'll throw that in there in editing. Technology. We're in 2021. We'll figure something out.
Yes. So, okay, this is just a great piece on the value of diversification. So essentially, right, the past 2 years, you can see 2019, 2020, US large cap has done very well, dominated.
Yeah.
And the last 10 years, right, US large cap has done very well. Small 100%. Cap just behind it. And so, that's where, especially for young investors too, that's all they've seen. But if you look back the 10 years before that, US large cap was the bottom performing asset class, right? So if you're thinking about the next 30 years, you just might want to second guess your uncle's advice.
Right.
And that's, just something I think that's worth sharing.
Yeah, 100%.
Not advice, but it's just common sense looking at history.
Yeah, because that's one thing that, a lot of people, that I guess invest like very emotionally. They'll invest based on where the market is right now, right? And they'll say like, oh, well, right now this is doing really, really well, so it's going to continue doing really, really well for forever. And then next year, when US large cap, like you mentioned, is doing really poorly, they're like, oh, the stock market is doomed. You can never invest in the stock market ever again. But it's about finding kind of that balance of like, being diversified to some extent and investing a little all over the place. But yeah, thanks for sharing that. I did this brings back some memories from when working together, but and sharing that with our clients. But I haven't seen that graph in quite a while. But if we flipped it now to, we spoke about the equity side of things before we jump into, because you spoke about the S&P 500. So I want to speak about the ETFs and following the index. But before that, if we spoke about bonds specifically, and on the other side of the equities, like what bonds are, if we were to simplify that to someone that, let's say I walk into your office and I tell you like, my grandpa told me to buy a bond. I want to do that right now. How would you explain to me what it is and how bad of an idea that is?
Well, I'd probably have 10 follow-up questions for the person, but generally, okay, so we just talked about stock, right? Issued by a company to raise capital, grow their business, whereas bonds are fundamentally different in that bondholders, you and I, are creditors to the corporation or government and are entitled to interest as well as repayment of principal, sometimes even in bankruptcy. But bonds can be issued by companies, states, the government, again, to raise money, but essentially you're taking on their debt and are paid a certain amount of interest. For example, treasury bonds can default but pay a lower rate. You can buy bonds for building roads through the city, like a municipal bond, and it's a lot riskier and could default on their bond. Whereas like a treasury bond, like I was just saying, they can't default, so that you pay less, but it can't default. So again, there's, different variances here, even with bonds, but it all depends on what it is and who's backing it, right? So you can see different ratings, like bond issuers, like Moody, if it's AAA, BBB, that's something to take into account. But yeah, if I were to just kind of give an overview, bond prices, this is important, it's inversely correlated with interest rates. So when rates go up, bond prices fall, vice versa.
Yeah.
So interest rates being low at the beginning of this year, now just starting to creep back up, but bonds were actually negative for the first quarter. And generally speaking, people don't think bonds can go down, but they can.
Yeah.
Which some people are very surprised by that. And so while generally they are a safe investment, the returns are going to be lower to what you'd see, in an equity market. But you have to pay a premium for that safety. So if you want it to be safe, you have to be okay with less returns. But, I think this is worth saying. There's a lot of valid reasons people have turned to bonds at one point. I mean, 2001, the dot-com explosion, and then 2008, if that wasn't enough, people had real experiences with down markets.
Yeah.
I mean, imagine retiring over COVID and watching your retirement bucket plummet.
100%. Yeah.
Properly educated.
Exactly. And
that's just real life. So the older you get, the more you're going to value those safe dollars. I think it's also, I was just talking to a friend of mine, but it's important for young investors to hear the market does not always go up. It's just true.
Yeah.
We base so much on our experience, right? I'm guilty of this too, but our experience doesn't dictate the past, present, future.
100%. And I think that we definitely, like, young people have probably fallen victim of that a little bit in the past year and a year and a half, especially because we saw kind of like this pandemic roll in and everyone thinking like everything is going to sink and fall, through the gutters. And next thing you know, the stock market starts exploding again and everybody started making money and like real estate's going up and people almost get to feeling like they're invincible, right? Like in this time where you really think that everything's going to crash, so many industries actually, made a lot of money. So you're right. Like a lot of young people need to be aware of, need to see the chart that you shared and need to be aware of, a longer time horizon, a longer history on the stock market. But that's interesting because, I think bonds are definitely, not a lot of people know about them. Like, so you talking about like some reasons you may want to consider them or take a look at them, but where does it fit? I guess, I guess if you were to speak about that, like, does it fit in someone's portfolio? Why would you even think about buying a bond for your safe? Like if you're a young person and you have a longer term horizon or whatever.
Well, and again, can't advise, but I'm mainly working with 30 to 35-year-old investors, and this is less a part of most conversations, just given their, like you said, longer time horizon.
Yeah.
And we're usually looking at other safe investment vehicles and options that historically have done a little bit better than bonds. But, again, you can't really advise here. Like it is so personal and it depends on someone's risk tolerance, but generally speaking, the younger you are, the more risk you can afford with that longer time horizon. And I mean, there's just so much out there, right? Like I wouldn't say like, hey, if you're this person, you should invest in bonds. You should look at all of your options because there's a lot of options, when it comes to safe money and aggressive money.
100%.
So hopefully that's cool.
Yeah, I think, one thing that I think I've repeated out on my podcast a couple of times, and I want to encourage people to think that way, is you'll get out there. There's so many ways to invest money, right? Like, but you're going to get so many people telling you have to invest in real estate. That's the only way. Or the next person is going to tell you have to do crypto or you have to do the stock market. Yep. That's the only way. The reality is like all those methods, if you look out there, they're not bad, good, or the next big thing. They're just different. They're different vehicles, and like you have to really sit down with a professional, in my opinion, and talk about what your goals are specifically and how does each and every one of those fit in, depending on your goals, obviously your goals, your situation at the moment, and your risk tolerance. So do love you sharing that. But if we were to flip to a little bit of that mutual fund and ETF conversation, how would you describe, because a lot of people that I speak to, at least, they have this, they either like super against mutual funds or and just buy ETFs all the time, or I get a lot of people that are just super against ETFs and that think that those I guess the gains that you can get from that is not enough, and like only invest in mutual fund. How would you balance those out? What even is the difference? Like, what is an index? What is a mutual fund? What's an ETF?
Yeah, well, I like both. I use
Mm-hmm.
both. It's kind of like a different tool for a different goal. Like, it's not like one is good or bad. So I'd like to kind of dispel that myth.
Yeah.
There are some, in my opinion, really poorly constructed mutual
Mutual
funds.
fund. Yep, 100%.
And if you're just slinging around different ETFs on the computer, it's probably not great. So I mean, okay, so a mutual fund, right? It can be made up of all of these things, stocks, bonds, etc. These can be more expensive if they're being actively managed, which isn't necessarily a bad thing. It's just a different approach, meaning there's a person, several fund managers making decisions instead of a computer.
Yeah.
There are so many different kinds that make up a compilation of investments. It's kind of like the Costco variety pack of chips. You've got your Cheetos, Fritos, Lay's, not just one bag. You don't just get one stock. So hold only Apple. Then if Apple tanks, your portfolio tanks.
Yep.
But if you hold a tech mutual fund, you've got Apple, Amazon, Facebook. So if Apple tanks, your portfolio doesn't tank.
Yeah.
So this is what you get in a more active managed mutual fund that might be a little bit more expensive, but can oftentimes, I shouldn't say oftentimes, but can beat the index expense included, return net of expense. So you can't predict this kind of thing, but there are companies out there that have a long track record of doing this in the index. What I mean by this is, there's an ETF out there that's really cheap, right? Generally, they're cheap. You have to be careful, sometimes if you are, you can rack up expenses if there's a commission involved or changing. And so you got to be careful, but generally, pretty cheap. That anyone could go buy and track an index, like the S&P 500 in the US, or what is it, TSX in Canada, right?
Yeah, most people still invest in the S&P 500, but yeah, I think it's the TSX, and but I don't know that many people that just invest solely in Canadian companies. But
don't Canadians love Canada?
We do love Canada, but not for our investing. We don't make enough money. But we do, like when it comes to like maple syrup, things like that, like that's where we really have that pride and love our Canada.
Wow. Send me some if you're listening. So, okay, but they've got a computer algorithm following that index, right? So the problem is this algorithm, it doesn't know to go by healthcare and technology when COVID hit, right? And the people managers did. You can guess who outperformed in comparison, which is why a lot of people started to reach out for an advisor in the past year, because in 2008, again, the computer, it doesn't know to go and buy airline stocks in hopes of holding them for a major rebound. It's not a brain, it's an index. This is where behavioral finance comes into play, which there's a lot of value in this. I mean, it's funny. A friend just showed me this, but there's I don't know if we want to do the screen share thing again, but it's one of the major players in tracking the index being Vanguard. They came out ironically with this advisor study. It's like the Vanguard Alpha or advisor, something like that. And it basically quantified the value of working with an advisor. And they're like the king of passive investments, right? So what they found is that working with an advisor adds 3% to your portfolio, which is insane.
Yeah, if you think about long term and what that does to let's say you end up with $1 million in your portfolio, you look at a serious chunk of change.
Oh my goodness, hundreds of thousands. And they actually contributed over 150 plus basis points to behavioral coaching. So it's astounding. I mean, It's really, this is why a lot of people want to work with someone. It's not for everyone, but I see myself some days more as a psychologist, because the value I really bring is the behavioral coaching to
Yeah.
emotional people dealing with an emotional subject, money.
100%. Yeah, no, that's rough. And since we're here, okay, I want to get into like the fun stuff, right? Because one of the biggest part of our job when we're working together, I felt like, was just actually trying, half the conversation wasn't even about finance. It was just convincing people how we're not all bad people, and and a lot of the misconceptions that people have about financial advice. And a lot of those are not necessarily just negative, but a lot of people think like, oh, I can't afford it, or I can't this, or I can't that. What are some of the biggest misconceptions that, this is the perfect time for us to vent, but like, what are some of the biggest misconceptions that you hear about working with a financial advisor that you may hear?
Yeah, I think there are several. I think the most common is, how much does it cost, right?
Mm-hmm.
People typically think of fee-based planning, like
Yeah.
an attorney, right? You go, you sit down, you pay thousands of dollars. Our firm, we have this platform, but we operate on other platforms too, right? Like, I love what I call a relationship platform.
Mm-hmm.
It's free, and you get great long-term planning as you work with a client for years on end, and you're reviewing the plan and adjusting it according to their needs and all that, the life changes you see. But basically, for example, if we're talking about that platform specifically, you get paid on the back end from the companies you place business with, right? Like, if I recommended a mutual fund, for example,
Yeah.
for sake of an example, and it made sense for that person, that client, the client doesn't pay me, they just go
Mm-hmm.
by the mutual fund, and I get a portion of what it costs. It's not more expensive. It's just, that's the innate built-in cost of the mutual fund that said company has, that split between me and that company it's placed with, right?
Yep.
Versus if you go buy that mutual fund for yourself, you pay 100% to the company, you buy it with. So it's a cool platform that I enjoy, just because I like the relationship aspect of it, excuse me.
Definitely.
But that's my personality. But
Yeah.
I think, those are the meetings I look forward to as you dig in year after year with people who now you have a relationship with, versus the fee-based platform, which is also great. But that's more for people who just want to pay you to be a professional second opinion and give them great advice and a personal plan that they can run with and have access to you, typically, me and my team, for a year, right?
Yeah.
For questions. But it's usually a one-time thing, maybe a repeat or two, but it's just a different approach. So I think that's the main misconception. But yeah, and I'm just, I don't know. I think people aren't as open. I think people just assume advisors will charge you for like a minute of their time.
Right.
Whereas
Exactly.
oftentimes, right, yeah, oftentimes people will hop on the phone with you for 10, 15 minutes to see if it makes sense for both parties to engage, make an
Exactly.
introduction.
And it's interesting, because if you're in this business, like, you really enjoy that. That's a big part of your job, is doing, to some extent, and I know that a lot of advisors, when they get older and they get more tenure into their career, they're less willing to do that. But a lot of the really young advisors, they understand that like a big part of their career, and a big part of their job is that unpaid labor. So, oftentimes they're very happy to sit down with you for a moment and, just share some knowledge with you. And because I remember when I was doing it, and I mean, a big reason why I have this podcast is because it's stuff that like I really just enjoy sharing with people, right? So, and also I want to tell people, don't ever be afraid. Like, you were obviously very transparent here on how, and one thing that I shared with the pot in the previous episode is, don't ever be afraid to ask your advisor, like, how, like, oh, wait, you're telling me that it is not a fee-based planning structure, like, so how do you get paid, right? Like, so not everyone will tell you up front, but they will always be very happy to tell you, to share that information, to make sure that like you feel comfortable as you're going through this, and that like it's a long-term relationship. But like, have you had in your conversation some misconceptions when it comes to investing specifically as well? Like, do you get people that come in that are like, no, I'm never going to invest in the stock market, I'm just going to put all my money under the couch because this thing is going to crash? Or what are some of the misconceptions that you hear when it comes to investing?
Yeah, well, if anyone has like a really strict rule that they abide by, like I'm definitely not going to do this or I'm definitely not going to do that, or just an apprehensiveness, it's almost always because something happened to them in the past, is what I've learned. And that's okay. Things have happened to me in my past too.
Yeah.
And there are certain things I avoid, like Brussels sprouts. But the thing is, many people have had really poor experiences with advisors in the past. And so it's easy for someone like that to just place that conception on me, misplace it, I would say. But, so it's less about like, hey, I want to do this or I want to do that. And it's more about asking, why is that? Tell me more. And so that's where a lot of soft skills honestly come into play, because the issue is not the issue.
Yeah.
And so hopefully that answers your question, but I do deal with emotions as much as I deal with math.
100%. And you spoke earlier about, sometimes just like having a 10-15 minute conversation with someone about if it's the right fit. Like, who do you think like really shouldn't work with an advisor? Like, who is it like an actual bad idea to go out and seek an advisor?
Yeah, that's a great question. Because people that want to take a few hours each day and research this stuff, they're the people who are researching companies. They're rebalancing their accounts accordingly. They're researching fund managers to see who has their tenure. They're looking at expenses. They're looking at tax repercussions. How will this affect their overall financial picture and other holdings? So I'd say those are the people, but I'd also say they're few and far between. I'm good friends with some, and I think they would also admit that. And I think they would also admit it's a lot of work, and and that most people should find someone to help them. But actually, I've had a few even say they'll work with me. They'll be working with me one day because they're all tired and busy. But it's kind of like going. I feel like you will resonate with this, but it's like going to the gym. There are some people, maybe you are one of them, Julian, I don't know, but there's some people who know exactly what their goals are and how to achieve them. And they're putting in the time day in, day out to achieve those goals. They're constantly adjusting their workout routine. They're making sure they aren't missing anything nutritionally. They have Excel upon Excel of their day-by-day plan for the year to eat the right things, work the right muscles, train the right way.
Right.
There are those people. And then there are some people who would prefer a coach. Some people want to pay an expert a little bit more to get the desired results and personalize it to them and, have them do all the thinking.
Yeah. And that's actually interesting, because I definitely kind of am that person, but for everything, I still do find myself wanting a little bit more of that accountability, or wanting that accountability partner beside me, because I do a lot of that, and I'm really interested, whether it's my training, whether it's my portfolio, my finances, all of that. I'm very interested in it. So I'm always doing research. I'm always doing a lot by myself, but I also really enjoy, like, usually when I meet my financial advisor, and I have this theory, and I spoke about it in my podcast before, that my financial advisor absolutely loves me, because I just go to him and I'm like, I need to purchase this. And but I also like working with an advisor, because I expect that if one day I come to him and I'm like, I'm going to do this really stupid thing, that he's going to tell me like, no, that may not, we've done a lot of good in the past, but this is not your brightest idea for this and this reason. So that's why I kind of enjoy and I don't mind paying the premium in order to work with that person. It's the same thing when it comes to working out. I love watching, workout video, understanding nutrition and all of those different things. But I still enjoy working with a trainer that's going to tell me every once in a while when I'm, whether it's, you need to work a little harder or maybe you need to rest today. So I do enjoy kind of that accountability. So I love that you kind of spoke about this. But I want to ask you a question that's important for people out there, because that's actually something that I touched on in the past, is like how to look for an advisor. And except Googling your name, what is a strategy, or what should people be looking for when they look to work with an advisor?
Yeah.
The obvious answer would obviously be Googling your name, but outside of that,
that's so good. I feel I have a lot to say. Because if we just maybe back up first, like there are advantages to working with an advisor, right? And what worries me about people is that they hear something, they read something, and they want to copy. People think they can be, this expert in every area because it's the age of technology, right? Google. Some of the things I've seen, some of the portfolios I've seen from really smart people, that they've put together are pretty outrageous, and they've missed out on multiple efficiencies, right? It's very seldom that someone actually does all their financial planning successfully.
Yeah.
So, and these aren't nobodies. So it just, I think, there's so many comparisons, right? Like this is just like the fitness industry, because the fitness industry, there's so many big food companies and multi-level marketing trying to get you to like buy a quick fix, right? This quick fix, this quick solution. That's usually a pill or some fancy powder you eat. But this is tough for the consumer because there's so much bad information and false promises out there, and bad advice. And so again, something as personal as the financial industry. So it's hard to even know, like, should I listen to this guru on this podcast? But when you're looking to just try to sift through the garbage and be aware of different efficiencies out there, I think first of all, fiduciary is a buzzword, right? So when seeking out a financial advisor, it's a buzzword, and it's important. I'm a fiduciary. I get asked all the time if I'm a fiduciary.
What does that mean, if you like, for the people that don't know?
Yeah, so it means that I'm legally and ethically bound to act on a client's behalf with their best interests in mind. Now that's extremely important, but I just recommend people to take their vetting process a little bit further than this. Frankly, between us, like the test to become a fiduciary is not that hard. And so I would take it further. I wish people would start asking questions like, how long have you been in this role? Okay. Do you have your Series 7? Do you have any designations? CFP, RICP, ChFC, CLU, right? How would you describe the value you bring to clients? What are your values? I would
100%. Yeah.
And so, this is the clients that love me the most are the ones that share similar values.
Right.
So
it's a big people business, right? Like you're trusting someone with like more than just, like, I think like I encourage almost people to think, well, you're not just trusting them with your money, you're trusting them with like your future, right? Like with what happens to you in the future, the kind of life that you want to live, because the money is just a tool. Like it's going to enable you to do certain things that you really want to do that are important to you. And that's what you're really trusting this person with. So you kind of have to align on a deeper level than just that. I love like the fiduciary thing. I have like a funny story to share about that, because I was in a meeting once and a client asked someone that I was working with if he was a fiduciary, and there was this like really long-winded answer that essentially the answer led up to yes, I am, but it was just so long that the client was like turned off and decided not to work with us anymore. And I was just like, Dang, so like a recommendation to young advisors out there: if a client asks you if you're a fiduciary and you're a fiduciary, just say yes. Like, but yeah, no, but sorry, didn't mean to cut you off. Like,
Oh, no, it's just, I mean, I feel bad for the consumer. It's hard. It's hard to know. You know, and if I were to try to go connect with an expert in a field, you know, that's very personal to me, but it's very hard to do that.
Yeah,
It is. You want to be armed with the right questions.
100%. No, definitely. And yeah, what was I going to say? Because so what are some of those like questions more from a technical standpoint, I guess, like outside of just the time they've been in the field, or the certifications that they have? Like, do you have any more questions like that someone should be asking or should be interested in outside of that?
Yeah, well, time designations are important, right? Like,
Mhm.
how long have you been in this role? If it's 6 months, they might not be the advisor for you, and they might not
Yeah.
be there in 2 months.
Hmm.
And again, like, what company do you have? Like, what kind of access do they have?
Yeah.
If they work at like, I can't name companies, but I have access to multiple
100%.
companies and renowned funds, versus, you know, you might be seeing someone that literally can sell you a handful of products,
Yeah.
and you'll have no idea. And so it's just, and as far as the designation, I just say that because so it's not just because I have one, okay? Because I'm
Like
very
I said, the easy way to explain this would be just to Google your name, and then they can find you, and then they don't even have to consider any other advisors. Then they're good to go.
Oh, it took me so long to get it. I mean, it was 2 years of my life,
Yep,
but you know,
100%.
that shows I'm committed, right? And it
Yep.
also shows a breadth of knowledge and, frankly, bragging rights. You know,
Hmm.
people are familiar with some of those, and so they know that I'm not messing around.
Yep.
You know, I don't have a goal in mind to change my career in a couple years. So that's just like a lot of staying power. But I would focus on the value. You know, what value do you bring to your clients, Allison? What are your values, Allison? Because really, they're 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 buying me,
Hmm. Yeah, yeah, yeah.
and that's who's going to be following up with you every 6 months to a year. So you're going to want to align on those important things. And sometimes I tell people, you know, just different like communication. You've kind of, you want to be able to understand what they're saying to you, right? Like, I've had people switch advisors to work with me. And I don't, I'm not like a super fancy talker. I'm
Yeah.
pretty plain. You know, I'm just your regular old cowgirl living the suburb Shakopee life, and me and my horses.
Yeah.
So
Allison
I
does have
am,
horses, guys.
spoiler. So, you know, the way I talk to people is pretty, I don't know, I guess I'll use the word straight shooter, but that's something that I do think is important. I mean, I've had people change advisors. They had no idea that they were paying 3% of their portfolio every year
For
to
sure.
their advisor. And I said, you guys know, do you see what's happening here? And they're like, no, we had no idea.
Yeah,
So
it's important because I think that a lot of professionals, like I mean, I've experienced that, and I'll share these stories. That's enough story for another day. But in real estate, you know, they try to wow you with fancy terms and fancy names, and they're like just to get you to the point where you just don't understand and you don't want to ask questions. You're like, oh, this person got it, and
sure,
they
I'll buy.
really, yeah, exactly, and you're just like, oh, it's way above my pay grade, so I'm not even going to ask questions, and you
Mm,
really get caught in that way, but.
yeah.
Man, all of this, I feel like I could do this all day long, but all of this was such great information. Like if people want to know more, people want to know more about you, want to work with you, whatever it is, how can they find you? I'll give you, you know, a couple seconds here to give your perfect pitch on like what do you have to sell to us? Because that's what we do. That's one thing I pride myself in, is making sure I strategically put in there and shamelessly sell something every single time I speak to these people. So go ahead. You go ahead. You have the floor, Allison.
They can just email me, just call me. I'm a normal person between business hours.
Make sure you put that in there.
You can link my email. I'm a pretty, I'll just talk to you 10 minutes and we'll know if we should engage. So
100%. Yeah. And I'll share all the information that's needed in the description, guys. But Allison, thank you so much for joining us. Thank you so much for the knowledge, for the wealth of knowledge, for the information that you shared today. I'll be obviously wanting to selfishly have you back on the podcast and share more information in the future. And also just because you're so great friend as well. But for you guys out there, listen, I tell you guys this every week. And if you haven't done this yet, make sure you subscribe to the podcast. This is the kind of people that we're bringing in. Like, this is, Allison's taking time out of her day. I'm taking time out of mine. All you need to do is click those buttons wherever you're listening to this, right? We're on YouTube now. You on all your favorite podcasting apps. Make sure you do that. What else do I need to shamelessly sell you? Make sure you like it. Shows me that you actually enjoy my presence. Even if you don't, just go ahead and you like it and share the podcast with someone you care about. That is the only way that this podcast and this platform grows. But for today, make sure that you're taking the steps today to ensure that you're 1% closer to your goal than you were yesterday. Have a great day, everyone. Thank you for joining.